Hello everyone, welcome back to the Rational Investor School for Trader Development. Here we are in our Level 1 program, our final module here for this Level 1 program. Our tutorial here today is on liquidity events. Basically, as you can see on the screen, we're going to cover the specifically liquidity events with regard to news events and liquidity events with regard to kill zones today. A lot about what we're going to be talking about here is really a function of understanding that sometimes in the market it's actually better to time your purchases based on events that happen in the market rather than specifically about location. So what are we going to be talking about today? Tutorial should be maybe about 20 minutes, half hour, that kind of thing. And of course, we'll cover everything listed on the topics page here. We're going to first talk a little bit about what the heck a liquidity event is, and not a bad idea to have a working definition for you. We're going to talk about news events as liquidity events, both macro events, specifically, if we have macro fundamentals, and this is, of course, going back to our introduction to fundamental events, the difference between macro and micro fundamental drivers. But we're going to give you an example of a macro event, and then what I would consider a micro event with regard specifically to Bitcoin. So I know a lot of people take this course with a crypto bent. So specifically, we're going to be looking at the way news events drive price, both from a top-down fundamental driver perspective and a bottom-up fundamental perspective. The second part of our presentation today is going to be about liquidity events with regard to opening exchange events that happen throughout the world on a regular Monday to Friday basis. I also find it really interesting too that, specifically with regard to crypto, because it is a 24/7 environment, we even see on things like the weekends these very specific liquidity windows play a role in our trading. So it's really important for us as traders to understand these liquidity windows, why they occur, and how we should really approach these events. And then finally, we'll just give you a working example of how I use a liquidity event to frame a particular trade idea. So without further ado, let's get on to it. What the heck is liquidity event? What is liquidity? Probably the first and most important concept here is this idea that liquidity isn't actually a specific number. It's kind of like a ratio, if you will, that's floating in time and space. When we talk about liquidity, what we're talking about is the degree to which an asset or security can be bought or sold in the marketplace without affecting its price dramatically. In essence, a liquid market or liquidity in itself is characterized by a lot of trading activity. In essence, a lot of volume is moving across the tape. Assets that can be easily bought or sold in size at a specific price are known as liquid assets. It's very hard for us, Joe Six-Packs, we're thinking about maybe 1 Bitcoin or 5 Bitcoins maybe as a big trade for us. What we need to understand is the whales, the institutions, whether it be Bitcoin or whether it be the stock market or the bond market or commodities markets. These people deal in like millions of dollars, millions of euros, whatever, which might equate to thousands of Bitcoins, maybe hundreds, but we might even see thousands. That would be, quite a few Bitcoin. We definitely see on exchanges like OKCoin, we see transactions in the thousands of contracts, and the biggest holders on OKCoin have like hundreds of thousands of forward contracts. And what we need to think about with regard to liquidity is how easily those big players can move in and out of a market without affecting the market price dramatically. We do need to understand that there isn't any sort of specific formula. It's not like you can go X plus Y plus Z equals your liquidity. Because, as I had said to begin with, this is really more about like a ratio kind of environment where, say, a high liquidity environment might have like a 1-to-1 ratio, and a low liquid market might be like 10-to-1 or 1-to-10 or something. So think about it in sort of relative degrees of liquidity. If we think back to our introduction to the FIBS tool and the idea of the institutional fingerprint and how institutions, smart money, whales, whatever you want to call them, they will literally put tops in markets and bottoms in markets. And sadly, of course, the public is either, if the institutions are putting a top into the market, then the institutions are selling in size to the public. Or conversely, if the institutions are trying to put a bottom in the market, they'll be buying in size from the public. And if we think about this institutional fingerprint kind of concept, understanding that the institutions need to get filled in size, they will lose these liquidity events that we're going to talk about to do those transactions in size. So as we're working through this module, try and keep in the back of your mind that concept of the institutional fingerprint. Because in essence, remember, institutions buy down markets, they sell up markets, and usually we see the public most euphoric at the top, FOMO buying, throwing their money at the market, and into all that euphoria, of course, in comes the institutions to put the top in the market. We're going to talk more about this concept of news as a driver. And what we really need to understand coming out of this liquidity concept is this idea that a lot of times the public actually comes to the market and is informed about a particular market, usually at the end of a run. So usually what happens is this whole concept of this idea of the market is a forward discounting mechanism. Not a bad idea if you need to pause this to go Google this concept, this term, forward discounting mechanism. But probably the easiest way to think about it is I'll just take a couple minutes and we'll just sort of paint you a picture here. Let's maybe assume that we work in a widget factory and we work on the line, we make widgets 8 hours a day. And really, we have a social life outside of work, we have buddies at work, we work on the line, maybe we're part of the Kiwanis clubs, maybe we go to a local sports team, right? We've got to do the water buffaloes, right? We're just basically working Joe's six-pack. We collect a paycheck, we punch a clock, and we make widgets. And then, we're sitting working on the line one day, and then the manager comes out and is like, okay, everybody, the word from the higher-ups is we got a double production. And everybody's got mandatory overtime. We got to get this big order that's coming down to the pike filled. And so everybody on the line, big hum and haw, right? Oh man, we got to work more, right? Blah, 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 blah. Everybody's working overtime and we come back home from work, we're exhausted, and the wife's like, what's going on at work? Well, we're working overtime. The manager wants us to make more widgets. And this sort of, the word around the town is that the mill is really gearing up. And word kind of spreads. And keep in mind, we work in a publicly traded company, and our stock is publicly traded. So, after maybe a week or two of us all putting in overtime and we've doubled production and the higher ups are all excited because there's this big purchase order that was just proposed and we're getting everything all ramped up and nothing has really been announced to the public here. But at the same time, we go home at night and we're like, oh boy, I worked a long day. And the wifey and I sit around the dinner table, and she's kind of like, "Wow, you guys are working pretty hard. The mill, yeah. The word around town is you guys are really hopping, and things are really hopping down at the mill. Maybe we should go and buy some company stock." Well, there really hasn't been anything announced, dear, and we are working overtime. We'll get a bigger paycheck, so that's good with all the money. And the wifey says, "Well, maybe we don't buy stock today, but I'm kind of interested. And maybe she at the bridge club next day. Everybody in town's all talking about, all our husbands are working late at the mill, and there's supposed to be some big purchase order coming down the pike, but nobody really knows what's going on. And maybe the bridge club has an investment club, and they say, well, you know what? Maybe we'll just go buy some stock, right? Word gets around. And what ends up happening is, this whole concept of the forward discounting mechanism is it's plainly obvious to everybody that the mill's doing more business. But no formal purchase orders or press releases about earnings increases or anything has been made. And yet mysteriously you start to see the stock percolating higher. Why? Well, all the bridge clubs and all the gas station attendants who are servicing all the workers going to the mill, maybe even the workers at the mill, some of them are like, fuck it, man, I'm gonna put my overtime money into the company stock, somebody's making money here. And the stock starts percolating higher. And up it goes. And, then maybe the stock breaks out of a trading range. And then Brian and all his TRI crew all jump up and down that they see a stock technical breakout. So now we've got sort of a stock moving up, rumors about a lot of business, nothing really firm done. Then, chatter on the internet and chatter on message boards about this stock is in play and it's moving. And it sort of takes on an inertia onto its own. At this point, the stock price has moved up quite a bit over the past month or so. We're getting really close to finishing this contract. All of us have been working on the line overtime. We're making more money, and some of it's gone into stock. And the long and short of it here, the managers are relatively happy. We're going to deliver on this big order that has been rumored to be coming down the pike. Then we get to the actual announcement date. And keep in mind, the town now is in a buzz because everybody's all been, talking about this big contract coming down the pike, and the stock price has been moving up. And the message boards are all excited because the TRI boys are banging out doubles on the trade. But the long and short of it here is, as we approach the actual news announcement that the company had indeed landed this contract and indeed delivered on the contract and had indeed actually earned more money in the earnings announcement, we find that the stock actually goes parabolic into that event. And it's the end of the move. But the sad thing, of course, is that this is when the stock's going to be written up in the newspaper. This is when people are going to be all excited about the big event. And, there's going to be parades and whatever. And unfortunately, that's actually the top of the market. The news comes out. And now, mysteriously, a day after the news announcement, the stock is down 10%, 20%. Or if it's an altcoin, the floor falls out from underneath it. And you're sitting there scratching your head and you're saying, what just happened? In essence, this is the capitalist process. This is the forward discounting mechanism where, in essence, what ended up happening was people bought the rumor. But on the actual news event, everything about that potential news event had already been baked into price. And so as a result, once the actual news event comes, there's no further catalyst. There's no further news events to justify hyping the stock up anymore. And so what ends up happening, ironically enough, is on that event with no new news coming or expected down the pike, some people start to take profits. And, sadly, of course, into that event, that's usually when the price of the asset skyrockets. Of course, that's typically when you get FOMO, fear of missing out behavior by the public. And as we said, when it comes to if we understand the concept of institutional fingerprints, ironically enough, that's actually usually when the institutions are most active and they are, in essence, selling that news event. This is what is called the forward discounting mechanism of the market. And again, if we understand the concept of the institutional fingerprint, and you as aspiring traders now have to understand that for you to make money in this game, you have to start acting like an institution. You cannot act like the public anymore. So as a result, when the public is buying the rumor, and it's the news event day, and in hindsight, we look back and we say, gee whiz, we see the institutional fingerprint. We see where the institutions put the top in the market. The news event hits, the stock price stops going up, or a cryptocurrency or commodity or bond, mutual fund, doesn't really matter. Everything is subject to this buy the rumor, sell the news scenario. We can also, and we'll see this in a little bit, we can also actually have this go the other way around. Because keep in mind, just like our little story about widgets and the potential of the company making more money, more earnings, what this really comes down to is these two underlying drivers that drive all human behavior in the marketplace, right? Remember from our risk management course. And that is fear and greed. It's greed that fuels the buy the rumor. We don't know what the actual news is. We hear rumors that there's good news. And so as a result, this greed emotion takes over our human behavior. And ironically enough, usually that greed hits a peak right into the actual news event. Conversely, we can also have situations where investors are driven out of fear. And as we'll see in a few minutes when we get to the macro news drivers, when governments threaten to ban assets and ban their populace from doing things, that is a fear emotion that's going to be elicited out of the public. In essence, if I do own this and the government is going to make it outlawed that I own this, then I better get out now, because if I still own it after they outlaw it, the asset might be worthless. So what ends up happening is, just as our scenario with the widgets, as we approach a bullish scenario, buy the rumor, the actual news event, sell the news, we can sometimes in the market have the exact opposite, where you have a sell the rumor out of fear, uncertainty, and doubt. And then ironically enough, on the actual news event day, nothing happens. And if anything, the market just stalls. And we'll see that in glorious Technicolor in a little bit. Any sort of hint that, hey, the news actually isn't nearly as bad as what people thought it was going to be, and you actually might see the asset quickly and dramatically reprice itself right back up. Happens all the time. So, very simply put, the key takeaways that we need to understand about liquidity are: it is the degree to which a security can be bought or sold without moving the actual asset's price. If we are big institutions and we do orders in size, then we need liquidity to get orders done. And this is why we actually have these liquidity events on a fairly regular basis. And it's a way for institutions to move in and out of the market relatively easily in size. So especially when it comes to something like crypto and Bitcoin, what I've seen in just my few years studying Bitcoin is Bitcoin loves to move into big fundamental events. Whether it be things like government auctions, whether it be things like halvening events, whether it be things like exchange-traded funds listing, Bitcoin loves to move into catalysts. So by all means, this is directly applicable to both stock traders, crypto traders, commodity traders, bond traders, mutual fund traders. It's all the same. Okay, key takeaways we also just need to review here, right? Try and remember this concept of the institutional fingerprint, because as we go through this module, what you're going to see is that it actually makes a lot of sense why things happen the way they do. Especially if we understand. I mean, the saddest part about capitalism is that sometimes I actually see the media actually manipulated by capitalists, and these can be some pretty deep pockets like billionaires, to actually get the public to act in a certain way. Either elicit euphoria, get the public buying so that they can sell, or conversely elicit outright fear so that the public will dump in a panic and they can buy. It happens all the time. Okay, so moving right on. Hopefully we have a pretty good idea of what the heck liquidity means and how we're going to use this concept of the forward discounting mechanism to understand liquidity events a little better. So the first liquidity event, there's two modules to this presentation. The first liquidity event that I wanted to present to you is the news event. From our fundamental analysis module, we all understand the difference between macro news event drivers and micro news event drivers, just like we all understand the difference between macro fundamental, top-down, and micro fundamental, bottom-up analysis. So we have two scenarios here to present to you today. The first is what I would consider a macro driver, in that in the late winter, spring of 2014, on the other side of the Mt. Gox event, Bitcoin itself went into a little bit of a vacuum with regard to news. There just wasn't any new news to report on. We had this Silk Road reversal off to $50. We had the big spike up to $1,100. And in essence, we were just unwinding that bull. What was interesting through this period, I first came to study Bitcoin through that $1,100, $1,200 peak. And through this period, really the market needed to consolidate that really big move up. And as I said, there was very little in the way of news driving fundamental events. And what ended up happening here, of course, is as Bitcoin prices went absolutely haywire, a lot of Chinese participants started to get involved in the Bitcoin trading environment. And of course, the Chinese, historically, their society are notorious gamblers. They love to gamble. And through this event, this post-$1,100 rally peak, and this sort of vacuum of news, there was only one thing that dominated the marketplace. And that was this sort of conjecture, the news through the winter of 2014. And it's interesting, even to today, we still have this debate. But at the time, the news headlines were dominated by China ban talk. It had absolutely nothing to do with Bitcoin itself. It had nothing to do with Satoshi Nakamoto, nothing to do with the infrastructure, nothing to do with the ledger. The talk and the trade was dominated by this news of the potential ban of Bitcoin by the People's Bank of China. And literally, the news headlines was dominated through this entire period. There was no other conversation. What was really interesting about this, and I think it's a classic scenario, where in essence, anybody who was playing Bitcoin in China was highly encouraged to get out of Bitcoins. And it was literally day after day, week after week, we just turned on the terminals and it was China ban, China ban, China ban, China ban. On this slideshow, and you can zoom in on this on your own, basically that's what the headlines were all about. And the interesting thing about the headlines is there wasn't any specific China has officially banned Bitcoin. It was authorities are seriously considering banning Bitcoin. And that's important. Because what ended up ultimately happening was the People's Bank of China officially did come out and put out legislation and to the effect that curtailing business usage of Bitcoin in China, and that was this event here. So a perfect example of a sell the rumor, and this is a fairly precipitous drop in the asset, but when the actual news of the China ban hit, you'll notice that price didn't do anything. In essence, sell the rumor, and anybody that was going to sell got the hell out. And actually, you could argue, especially looking back in hindsight, this was a buy the news event. And I wouldn't be surprised if there were traders that did strap on shorts. And then on the actual event of the bank, the Chinese government coming out and saying, citizens not allowed to use it. And it didn't really stick very well because China certainly still does lots and lots of Bitcoin. On the actual news event, I wouldn't be surprised if a lot of these traders that sold the news, they simply covered their shorts. And they did so at quite a nice profit. So, really good example of a macro driver, a negative potential news fundamental event, government banning the use of cryptocurrencies and Bitcoin, a classic knee-jerk reaction of negative implications of news and the asset collapsing in price, and then when the actual news event happened, basically the asset didn't do anything. The irony of it all is, you would think intuitively the day that they announced, all right, you're not allowed to use Bitcoin anymore, that would be the day that it collapsed. But that's not the way the market works. Hopefully you guys can now see from a macro news driving event this concept of the forward discounting mechanism. This is the way capitalism works. You just have to understand that. All right, so there is our macro example. And by all means, grab the slideshow presentation and zoom in on these news events and do some cross-research on your own to validate the thesis here. But in essence, it was, I traded through this. In fact, for 2014, we called this bottom the trade of the year because it translated into a really, really nice long trade for us. All right, so let's now switch to a micro or very Bitcoin specific event and how it played out through the market. So we had the sell the rumor, buy the news scenario. What was interesting is shortly after the big China ban news, the price just stopped going down. And actually, all of you guys now should be able to see the beautiful little W here in price. And then, on the there's just no more Chinese to sell. Which way should we take price? Well, sell the rumor, buy the news, up goes price. Big surprise. The question really, and I remember through this period, the question was, okay, maybe this is a dead cat bounce and this is nothing more than technical, but at some point the market actually started to get bid up. And the market, crypto is no different than, our ABCD widget company. The market started to get bid up and people were searching for fundamental news. What's going on here? Why would price be moving up? And our attention quickly got drawn towards a U.S. Marshal's Office auctioning of seized Bitcoins from the Silk Road government seizure. In essence, what ended up happening was, and I was in, TradingView lounges and on Reddit and all those kind of sites. And of course, our little site was getting going through then. And the talk transferred from, everybody had forgotten about China ban. That was old news. And it's incredible how short traders' memories are. At this point, now all we were talking about was U.S. Marshal's Office auctioning of Silk Road coins. That was the only thing that people were talking about, and what was going to be the final bid price for these coins. In a weird sort of way, I kind of believe that a couple things happened here. Number one, this, China ban, sell the coins. I kind of believe that a lot of Chinese public simply sold their Bitcoins to government officials. And then the government officials, knowing that this Silk Road auction was coming up, simply helped the market up, and it built up some inertia. And then in essence, that's all we were talking about day after day, week after week through these months about, okay, what's going to be the final bid price for these coins. So what ended up happening here is, this being a public news event, something very specific about Bitcoin. And of course, the government, U.S. government is tied to it. So what we need to understand here, of course, is that this is going to be put out in the newspapers. This is going to be on like nightly newscasts. Might even be written up, maybe a op-ed on like a CNBC or Wall Street Journal or New York Times. Somebody's going to mention it. And what we have to understand, very simply put, is, the public is going to be made aware of Bitcoins again at this level, at this time on this news event, the government auction. Is the market going to allow the public that completely lost interest in Bitcoins down here? Is the market going to allow Joe Sixpack, who just opens up his newspaper, oh, look, Bitcoin auction. I was thinking about buying some Bitcoins. Maybe I'll go buy some. Is the market going to allow Joe Sixpack to go in and buy Bitcoins at bargain basement prices? And the answer clearly is no. One might argue on this fundamental news event by the rumor, one could argue that traders anticipating that the public is going to be made aware of Bitcoin and the public may come in and actively want to buy Bitcoins, they're going to have to pay a bit of a premium to participate. And in essence, I would argue that this fundamental news event, the U.S. auction, Marshal's Office auction of seized Bitcoins, was in essence a buy the rumor event. And sadly, of course, you can clearly see on the other side, a sell the news event as well. In essence, once this fundamental driver was out of the way, there was no fundamental news on the other side of this event. So this could be very much like our widgets getting bid up into the big news event. The news event happens. On the other side of the event, there's no more reasons to buy in the short term, and the price just melts away. Very normal. And of course, the public coming in and buying up here, they're going to be punished. Sad, but often very normal and very true. So, a couple things that we need to take away from this, right? Just you as professional traders, you must understand that 9 times out of 10, a news event is a selling window. It also brings in those higher time frame players that are looking for liquidity to get filled in size. I don't recommend that the new trader try and pick tops and bottoms through these events because sometimes they can be extremely violent. I would all challenge you, go and look at what price of Bitcoin did through the November 2016 U.S. Actually, I think it was November 2015, beg your pardon. November 2015 U.S. Marshal's Office auction of seized Bitcoins. It was quite a bit more parabolic than this news event, but it acted exactly the same. And on the other side of that event, price melted away. So, you have to take away from this that fundamental drivers are going to bring liquidity. They're going to bring the public into the market. It may be on the sell side. It may be on the buy side. And we have to understand that the news event is the liquidity event that the higher time frame players are looking for, maybe to get filled on buy side in size, maybe to get filled on sell side on size. But the public is usually doing the wrong thing at the wrong time, and they're playing into this institutional fingerprint concept, right? If we now look at this chart and we look back now, we can clearly see exactly where the institutions put the bottom in the market. Conversely, when we look back, we can clearly see where the institutions put the top in the market. In essence, sell the rumor, buy the news, buy the rumor, sell the news. Okay, so that's our first liquidity event concept that you need to get down. In fact, just so we make it perfectly clear, when I was prop trading and day trading with other people's money, it was absolute cardinal rule you were not allowed to hold positions heading into news events because you just don't know what the hell's going to happen. And these would be like big news events, interest rate decisions. I was a crude oil trader, so couldn't hold positions heading into weekly inventory numbers. Because, let's say I was short, or long. Let's say I held a long position into this liquidity event and kaboosh. Sometimes these markets, if it's a shocking news event, price can move dramatically in the other direction, and it's a big no-no. So hint, 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 question on the final exam. You are encouraged not to put positions on heading into liquidity events. It's perfectly all right to consider buying structural bottoms ahead of those events, but for God's sakes, don't put on a new long position heading into a news event. That's just asking for trouble. Conversely, same thing here. Don't put on new short positions heading into a news event. You might just get run over. Okay, so our second conversation that we wanted to have here in this module was more to do about the time of day you do your transactions can sometimes be actually more important than the very specific level that you're trying to do it at. Understanding, again, that institutions, if they need to get trades done in size, need liquidity events on a regular basis to get filled in size. And there are 3 very specific windows every single trading day, and I even see it now on the weekends with crypto, where we must be cognizant that these are liquidity windows. Specifically, if we think about the globe, there are 3 economic regions of the world. There is the Asian region, and as the day, starts, Japan, land of the rising sun, in essence, the world's day starts in Asia. Then we move on to the next liquidity window, which is the European economic region. And in essence, as Asia is sort of getting halfway through its business day, then Europe comes online and it goes through all of its opening exchange behaviors. In essence, it is the European liquidity window. Finally, as this sort of Earth goes through its normal day, the last sort of economic region to come online is the Americas. And of course, since the end of the Second World War, because to de facto degree, the United States of America is the world's sort of economic engine, the North American session carries a lot of weight when it comes to capital flows. All right, so those are the three economic regions. And if you need to take a globe and just look at the way the globe turns through the day, you'll understand why there's an Asian zone, a European zone, and an American zone. We give these zones specific reference points to sort of where the most economic significance is done. And to all intents and purposes, while there has been a debate in the early part of this 21st century, one might argue that de facto still to this date, the city, the location, the region with the most economic clout, the most economic influence is centered around Tokyo. So in essence, we actually call this first zone of liquidity the Tokyo kill zone. And think of these liquidity windows as nothing more than kill zones. If we think about the way we humans behave, it's actually fairly predictable from one region of the world to the next region of the world to the next region of the world in a very general sense. There are three significant fundamental events that happen through these windows, and the concepts are universal, whether you're in Asia, whether you're in Europe, or whether you're here in the Americas. The concepts are exactly the same. So let's go through what these typical influences are. And then once we sort of have them down for the Tokyo zone, we'll move through the European zone, give you the reference points there, and then finally to the North American zone. We have on here a very typical asset and the way that it trades through its sort of 24-hour trading day. Very normal, actually. So let's first, before we get into that and all the different zones, let's talk a little bit about what some of the drivers are and why they're relatively universal from one region of the world to the next. So, in the classic business model sense, Monday to Friday, 9 to 5, and in this sort of 20th century, even to a certain degree, 19th century world, we live in this 3-day settlement. And actually, when I started in the business, it was 5-day settlement for equity purchases. Some jurisdictions are same-day settlement. That doesn't really matter. What matters here is this concept that a lot of investors around the world will do what's called buying on margin. It could be something like a futures contract, which is actually already pre-constructed and has set margin rates, and you just put down X amount of dollars and you control this massive equity position. It could be on like 1,000 barrels of crude oil, 100 ounces of gold, could be on 5,000 bushels of wheat, could be on 10,000 heads of broiler chickens, right? But typically in this scenario, this conversation, margin positions are really popular in the stock market, where basically, 10% down, 20% down, I can control a $10,000 asset with $1,000 down. And of course, if the asset moves up, then I enjoy the benefits. If it moves down, then I have to incur the losses. We can talk about margin debt and stuff like that. In fact, in the risk management module, we go into a little bit of how the margin system works. But the long and short of it here is you have to put up X amount of capital. And if your capital falls below a certain threshold, then the brokerage house will liquidate the remaining position because they don't want their capital that they're loaning you to be at risk. That's what's called a margin call. Typically, and if you think about sort of 20th century, 19th century world, it was a very paper world. So what ended up happening was at the close of business day, all the transactions would be sent to the back office. The back office would do the math. Then the back office would inform the brokers that, hey, your client is under margin. If they do not put up X amount of dollars to cover the margin difference, their position will be liquidated on the open the following day. It was very normal. And in fact, in North America here, our stock markets, the New York Stock Exchange opens at 9:30 a.m. Why 9:30? Well, it actually gave the brokers enough time to call their clients, while the business day was on for the clients, so the broker knew that they could get them and get the assurance back to the brokerage house that, yes, Mr. Client wants to maintain the position and the check is in the mail. If the client did not, either want to hold on to the position, have it margin called away, or was unavailable, well, at least the broker can say, hey, we tried best efforts. The position will just simply be liquidated on the open. Now, understand that there are players in the market, these big fish, right? The institutions, the whales, that need to get filled in size, 100,000, million, 10 million, $100 million trades, whatever. And they will use these margin calls, this forced liquidation into the market to give them their fills in size. So, well, it's not the case here for Bitcoin, but let's just assume that, let's say this red candle here was the margin call level. And if the market opens up, and all of those people that had margin positions, they're now officially underwater, there's going to be a big whale here, big fish, big institution, that is literally wanting to buy up all of these forced liquidated positions. It's very normal in the stock market. Markets are moved to margin liquidation positions. We even see it in crypto. Margin positions are liquidated right into the strong hands. We also need to understand that, if you're a Fortune 500 company or if you're any government official, there's no bloody way in hell you're going to be at the office at 2, 3 o'clock in the morning putting out news releases. It's just not going to happen. So remembering our buy the rumor, sell the news, sell the rumor, buy the news, quite often, we have a lot of economic and company-specific news events right on the exchange open. In essence, that again injects a whole bunch of liquidity into the market all at once. And quite often, we see economic news events. They are initially, the market pushes one direction. Sadly, that might actually trip up margin calls, right? And then ultimately, let's say it was a sell the rumor, buy the news event. Right here we have the New York Open. In this case, you can see price dips down. And then an hour or two later, you notice that the price is actually starting to work its way back up. So typically normal. In fact, when we get to the New York kill zone, we'll talk specifically about that. The last item that we need to understand, the last influencer with regard to these liquidity events, is this relatively new concept. Keep in mind, you guys new to trading, this concept really hasn't been around that long, maybe like past 10, 15 years kind of idea. And that's this idea of a whole new category of traders called day traders. Now, like I said, about 10, 15 years ago, a lot of commodity trading houses, led by these big clearing corporations like the CME, Chicago Board of Trade, Chicago Board Options Exchange, etc. They introduced a product where an individual could put on a position in a commodities market or in the stock market at a substantial discount to what overnight, or people that would buy and hold the position, their margin rates. Like literally like 10% of the margin requirement. So you might have like a S&P 500 futures contract where to hold the position overnight, you had to have like, say, a $30,000 deposit. But for this new day trader class, as long as, number one, you did not have the position on before the market opened, and you absolutely guarantee that you will have the position closed by the end of market, 1 o'clock closing bell, ding, 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 the exchange would let you have that position on for like maybe $3,000 margin. I mean, a huge, huge discount to overnight positions. So, we as, students of the market and as students of capitalism, initially we have to ask ourselves, why would the exchange do this? Is it because they're really nice guys and they want to level the playing field for the public? Maybe, but hey, this is capitalism. Let's maybe think about what their motivations are and how this might serve their desire to get filled in size, and how this might actually be a potential liquidity pool. For starters, if a guy can come and start day trading with only a few $1,000s, he probably doesn't have very deep pockets. So, let's say maybe, and we often see this in the marketplace, let's say maybe they engineered the market to look like a bottom on the exchange open, maybe, or even, maybe they make it look like the sky is falling. News event, this market's cranking down. Keep in mind, this candle at one point was right down here as a big fat red candle. I'm collapsing. Sadly, of course, a lot of people that come to day trading, they fancy themselves as traders, but that doesn't necessarily mean they're going to make money. And they may get suckered into joining the bandwagon. Oh my God, the employment report was horrible. I totally thought the stock market was going to collapse. And they end up, because they can't have positions on here, they are day traders. They can put the position on as soon as the market opens. They see this and they're like, oh, this is a bear. I got to get short. But what they're actually doing is they're selling and they're shorting into the big players, the institutional guys that are putting in the fingerprint. So in essence, hopefully you can see, through this exchange opening event, the market was heading down. The institutions, the whales, the smart money put the bottom into the market, got all the public all jazzed to go short. The day traders, they all opened up, ding, 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 ding. Oh, you can now officially do business. Sell, 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 sell. And they were just literally walking into a trap here. It's very, very normal in the marketplace. So we also need to understand too, and that's why I've sort of outlined this image, day traders also must liquidate their positions by the end of the day. So let's say that you were short, and let's say you were a European trader and we're coming into the European close. What ends up happening here, of course, the New York boys put the bottom in the market and the market starts drifting higher. And then all of these European traders that have to close their positions by the end of the close, that pushes, because they're all short from up here, they're buying back those shorts, that pushes the market up even more. So what ends up happening here is that quite often this day trader category, even though they think they're smarty pantses, they're often actually puppets. They're being used, they're pawns of the large institutions, and their liquidity is actually feeding the institutional fingerprint guys. So, put it together. Margin calls, ding, 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 margin call, flush, liquidation, you're all under margin, get the hell out. There's a massive injection of liquidity. Then maybe we have econs come out. Holy shit, the economy's worse than people thought. Sell, sell, sell. But that is a sell the rumor, and ironically enough, maybe buy the news, and the market actually pivots through that event. And then lastly, all the new day traders, the very shallow pockets, they can't take a lot of heat. They just fuck around with them a little bit, and they can flush them out of the market really easily. Put it all together, and hopefully you can understand the impact exchange opening events have on liquidity. And that's really the important thing here, guys, is we need to understand that these exchange opening events, that's why we call them kill zones. Because in essence, and our little example here is a perfect demonstration where, through the end of the day, we saw the market drifting. This is after hours. The market's drifting against these lows, and you can see that they start probing through these lows and they start pushing through them, trying to get the weak hands, the small day, and this is Bitcoin, right? So guys that are sitting on the message board, screens on 24/7, they see the breakdown through support and they're going short, right? And they're literally shorting into the Tokyo kill zone trap. You can see through the Tokyo kill zone, and usually we like to measure these kill zones at about a couple hours in duration. So the easiest way for you to understand these events is just find out locally what time it is. For Vancouver, British Columbia, Canada, where I live, the Tokyo kill zone is actually at 4 o'clock in the afternoon for me. And it goes through from about 4 o'clock in the afternoon to 6 o'clock. Just about good 2 hours. Through this window, we often see the market put in its pivot low. And often it's a trap that heading into this window, you see the market moving in one direction, and then we turn through that window and head the other direction. Not a surprise whatsoever. Now, the Tokyo kill zone, remember we had said Asia is the beginning of the business day. So quite often, in fact, we call this the Asian kill zone because it's really wide, right? If we look at a globe, the distance from like Auckland, New Zealand, then going through Tokyo, then going through Sydney, then going through Shanghai, Seoul, Beijing, all the way to Hong Kong. It's a very wide swath. As well, because it is the beginning of the business day, whatever kind of econs or general tone out of that environment is set, it often sort of resonates throughout the rest of the day for the world. So and especially since year 2000, maybe not so much nowadays, but definitely 5, 10 years ago, basically the whole world was watching China data, so you can imagine if the start of the business day we had a bullish economic report that was put out by China, that would basically set the tone for the rest of the world's day. Keep in mind, Japan is technically, well, I guess not now, but Japan and China vie for second and third largest economies in the world. So they carry a bit of economic weight. If they come out with relatively bullish news, well, it's going to set the tone for the rest of the world's day. Quite often what we see is markets get pushed into the next big liquidity zone, big liquidity event. And like we said, that's Europe coming online. So, Asia's come online, all of the different region. We call this the Asian kill zone. Very specifically, couple hours, but really I've often seen this develop over a 3-4 hour period. As we move through the evening, we go through Japanese lunch hour. There's a bit of a pause. Then we sort of have a surge through the end of the Asian session, and that sets up the European session. Now, we need to understand, there are a number of different economic sort of, focal points, power points. But, since the end of the Second World War especially, and then, of course, with the Cold War, a good deal of Europe's economic sort of center of influence was centered around London. And you could even argue in the early part of the 20th century, latter part of the 19th century, that Berlin and, Frankfurt, its financial district, and London often were at loggerheads as to sort of the center of capitalism. You could argue that the Germans and the British sort of went head to head over sort of world supremacy in the latter part of the 19th century and early part of the 20th century. So, a good portion of especially like Africa, Middle East, a good portion of Asia, actually a lot of its financial interests are still, even to this day, focused around London. And it's interesting that to all intents and purposes, the Forex community is actually still kind of focused around this London event. And with this in mind, as London as sort of the focal point for the Forex market, we often find, and you should make note of this if you are interested in Forex, that something like 70 to 80% of all weekly sort of pivots in the Forex market, sort of trend establishing pivots, are established through the Tuesday-Wednesday London kill zone. That's how important this European exchange opening event is. So if you are interested in Forex, then you have to pay special attention to the London kill zone. Now, the shitty thing for a guy like me living on the west coast of North America is that the London kill zone happens at about midnight my time. Wonderful. So I don't often trade the London kill zone, but I definitely see pivots. And depending on where you are in the world, obviously if you're in Europe, this exchange opening event is probably most paramount to you. What we often see is a floor or ceiling established through the Asian kill zone. The market moves to an extreme into the London kill zone. And then through the latter part of the European session, what usually happens is they do nothing more than bring the market back so that the New York boys can take the positions that the Tokyo boys initially established as a bottom. So hopefully what you see here is the market bottoms, institutions load up, The market rallies into this next liquidity event. Keep in mind the market is ripping higher here. So unfortunately, on this liquidity event, what do you think the public are doing? They're coming in and buying, right? They look at this and they go, oh, structural breakout. Brian says I got to obey W's. I see W's here. And on the exchange opening event, they're buying. Uh-oh. And so what do the bastards do? They put a top in the market and they slowly work it down through the entire European session. And into the New York session, they actually make it look like the market's collapsing. So the New York session opens, it's down, it's negative. And of course, what is the public doing? They're now selling on this liquidity event. And hopefully what you can see is that the public is selling right into the original institutional bottom. So in essence, the New York boys didn't miss the boat. This happens all the time, guys. In fact, I do a lot of my trading through the New York kill zone. I'll literally identify levels that I want to be interested in. And this happens at 6:30 to 7:30, well, we'll say 6 to 8 o'clock my time, Pacific time. And so what often happens is I wake up to nice fills. The public sees the market open and they're like, oh shit, it's going to ratchet sell. But I've got my bid working off of these levels over here. Cheeky little gap right there we could work an order against. And into that liquidity event, I'm actually buying. And in essence, that's exactly what the institutions do. Day in, day out. The really interesting thing about this is that I even see, because this is Bitcoin and we trade 24/7, especially when China was driving the bus there a year or so ago, we definitely saw a lot of institutional interest around this Tokyo or Asian kill zone. Literally day in, day out. In fact, it was kind of funny. Through this period here, we used to literally wake up. All right, when's China waking up? Because literally as soon as they wake up and they go through their very normal opening procedures every single day, keep in mind, 6 billion of us, we all have to sleep at night. We all get up in the morning. We all got to go crap in the morning or whatever. We all have our breakfast. It's remarkable how similar, even though we're very different, how similar our day-to-day activities are. So even on the weekends when business offices theoretically are closed, we still see these liquidity drivers because it's really just a function of just normal human behavior. Okay, so that basically summarizes number one, news events as liquidity drivers. And then number two, kill zones or opening exchange events as liquidity drivers. Really important that you understand these two concepts because in essence what ends up happening is actually a lot of our trade ideas, they often actually get triggered around these very specific events. Why? Well, hopefully what you guys have seen through this course is that we are teaching you the tools that the institutions use to trade. You are now an institution, whether you like it or not, which is kind of funny because in essence, crypto, we hate the banks, and the whole purpose of this course is to turn you into an institutional bank trader. Sorry, guys. So, the point here is we shouldn't be surprised if we've picked trade location and we've identified things like divergence and we've identified structure. We should not be surprised to see that these things all happen around these liquidity event windows and the big boys are taking the same damn trade that we're watching. That shouldn't surprise you at all. If anything, the fact that these events happen at these very specific times should almost give you comfort that, hey, I must be looking at the right level. I must be paying attention to the right things because they're happening exactly when the whales need them to happen to get filled in size. And that's the key to this. Remember, the whales can't put those trades on unless there's lots of volume that trades at relatively the same price. So, here we have a scenario where we just simply identified a range, we identified a potential buying zone, and we identified a potential selling zone. Very simple, common institutional levels. No rocket science here. But the public doesn't know these levels. So you draw your chart up, you paint your levels. I'm willing to be a seller at this level, and I'm willing to be a buyer at this level. We let the market basically, base, start working its way higher, climbing the wall of worry. And we notice that as the market is moving up into our level, here comes a bearish divergence in our momentum indicators. And gee whiz, our overbought, oversold indicators are flashing overbought conditions. So in essence, the market is ripe to come down. We are in trade location. We have the divergence set up. The market is overbought. And the coup de grace, big surprise, this is the London kill zone liquidity event window. Hopefully you guys can see what should happen here is, the sad part about it, of course, is that the public is saying higher highs and higher lows. This is a bull. I got to buy, buy, buy. We're heading into the liquidity event, and you can almost see price going a little bit parabolic here. People are panic buying. And sadly, of course, they are literally walking into a trap. So what we say here, liquidity events gives the big boys the window to put positions on inside, so don't get caught by them. If anything, like I said, we should expect to see the institutions get really jazzed around our levels, and these should happen around liquidity events. You have to actually, as a professional trader, start to anticipate this behavior. And I challenge all of you to now, actually go on your charts and mark down the liquidity event windows, mark down fundamental event events, and just watch and journal and note how price behaves around these events. I guarantee you, once you've done this a few times, you're going to be like, holy crap, I didn't realize how set up all this is. But unless you study for it, unless you actually look for it, you don't see it. So let's just reveal some rules of thumb and send you on your way. Number 1, do not put a new position on heading into a liquidity event. Was it a good idea for you to short ahead of this event? No. Was it a good idea for you to buy ahead of this event? No. Let the event happen, and then you can put a trade on. Remember, I told you with Nebraska, my old boss at the prop firm, he didn't care if you put on a trade after the weekly inventory reports in the crude. But for God's sakes, if you had a position on heading into that event and it wasn't heavily in the money, these guys would crap on your head, and hey, you might even fucking lose your funding. That's how serious these guys take this. So you take it that serious too. Do not put a position on heading into a liquidity event. You are just asking for trouble. Obviously, couple your analysis, right? You've heard me say time and time again, how many reasons do we have to take a trade? If you can layer location, divergence, overbought, oversold, with a liquidity event window, now you're on to something. And really, what I would suggest you do is just let the market move into the liquidity event window. Let it naturally flow. And then when we're there, then you can get all excited about hunting the setup. For lack of a better term, and it's not really nice, but we just have to understand this. This is reality. You now look at the market from a very different perspective than the public. My advice to you, and you can do this overtly or you can do this subtly, you don't have to be in their face about it, but use the very predictable behavior by the public heading into these events, whether it be Bitcoin halvening, U.S. Marshal Office auction, Litecoin halvening, liquidity event, interest rate decision, earnings report, remember, forward discounting mechanism, ABC widget company announcing signings of, and delivery of big contracts. Use the public's very predictable behavior, their very predictable activity to your advantage. You now know what they're going to do. We're here to make money from trading. Take advantage of that uninformed public to pad your account. That's what we're here to do. We're here to make money from trading. And then lastly, guys, we talked about the New York kill zone. Good example here where this was a total trap. We talked about the London kill zone and how the public probably was all euphoric bullish and that was a trap. We talked about the Tokyo kill zone, how they were breaking the market down, and that was a trap. The long and short of it here, guys, absolutely. And it was actually interesting when I was funded as a prop trader and they had my funding interview. I joked with the guys about how when I was a broker, our simple rule was never, ever, 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 question on the final exam, ever trust the first hour of any trading session. Don't get suckered into the bear. Don't get suckered into the bull, because it's usually a trap. Learn it, live it, love it. All right, so that basically brings us to the conclusion of our liquidity events tutorial. I hope you've enjoyed it. That was about an hour and a half. Of course, we'll review everything in class and make sure that you're up to speed. And be sure to book your tutorials, do your homework questions, and let's have really cognitive conversations about how we can incorporate these very predictable events into your trading. All the best, and bye for now.